Well, welcome to this early morning session at the Policy Exchange. I am delighted to be here, and particularly with a couple of MPs on the panel, because it's the first time I've chaired a panel with MPs where they can't rush off to vote before you ask them nasty questions. But I'm sure we can work on it as part of the productivity thing. Let me just briefly introduce, you've all seen the CVs, but on my immediate right we have Sally Javid MP, who is PPS to George Osborne and one of the high flyers on the Conservative side. On my left, Chris Leslie, not quite opposite number, but Shadow Chief Secretary of the Treasury, from my part of the world in Yorkshire, actually, originally, but now ensconced in Nottingham by the vagaries of elections, which move MPs on when they don't always intend to be moved on. Then James Barty, who's a senior consultant and financial policy advisor at the home team, one should say, at the Policy Exchange. Then Chris Cummings, who is the chief executive of City UK, the city's promotional and lobbying organisation. And on the far side, Jonathan Extend-wright, who's a partner in employment benefits and so on at DLA Piper, the city law firm. So the format will be that I will ask the panelists in turn to talk for about 3 or 4 or 5 minutes each, and then we'll throw it open to debate and discussion from the floor. Before we, I'll just sit down now, I've got your attention. The couple of things that I would like, when I'm writing about executive awards, success and failure, some of the 3 or 4 points which I grapple with in the context, which we may or may not get from the speakers, but I think help frame the debate. The first is that essentially the surge in executive pay started about 1992, 93 with the change of options. So we've had roughly 20 years of it. Now, if you look at the return on capital employed of British business for the 20 years up to 1993 and the 20 years since then, you see absolutely no change. So if you take a measure of the improvement of business efficiency and you take return on capital as being a reasonable one, a hard one to fake, it hasn't changed. So we have had a big surge in the way executives are paid, but we don't seem to have had any change in the underlying performance of business. The second thing I would like just to flag up and draw your attention to a bit of a paper by an American academic called Dan Ariely. I only mention this because he has done some research which suggests that bonuses are counterproductive. That incentive payments work on mechanical tasks, if you like, assembly work, or on something finite like a salesman and sales commission. But when you get into intellectual tasks, they actually inhibit the person doing the job. And the bigger the bonus, the more the inhibition. The analogy might be with a penalty shootout. In that the footballers in training can score 9 times out of 10 from the penalty spot. But when it really matters in a World Cup final, they freeze. And it's the same kind of mental process or psychological process that if there's a big bonus riding on that decision, if you like, the executive freezes or does not behave as they would normally, and the effect overall is counterproductive. So that I thought was an interesting thing to flag up. I suppose the third thing I have difficulty with is whatever happened to, or when we talk about performance pay, aren't we all on performance pay? Whatever happened to the principle that if you didn't perform, you got sacked? You turned up, you did the job. If you performed, you got more money and got promoted. If you didn't perform, you got sacked. When did we move to the idea that your salary was simply to turn up on Monday morning, and then actually to do something, you had to have a bonus or you had to have an incentive? This, I think, is a topic we could pursue. And perhaps the fourth thing I would flag would be what do we mean by performance? It's never actually adequately measured within business. And of course, performance is time dependent. You can perform brilliantly over 6 months, which would be disastrously over 12. So I think the separation of performance from time is an issue. The measurement of performance is an issue. And also the question of whether shareholders, who themselves are measured quarterly or at best annually, and who on average hold shares now for months rather than years, whether institutional shareholders who are themselves agents are perhaps the best people to be the custodians of the activities of other agents. So I toss those into the pond as something for you to mull while the experts speak. And if I may, I will kick off with the first expert on my right. Sajid, the floor is yours.
Thank you very much. Thank you. Thanks very much for that introduction, and thanks for putting this on and inviting me. Very thought-provoking comments. I thought in a few minutes I've got to kick this off. I'd actually just speak more probably from my experience prior to Parliament than the 2 years that I've been in Parliament. Before I came to Parliament, I was an investment banker on trading floor for almost 20 years. And actually, I do wonder now being an investment banker versus MP, which one is the more hated by the public? But I want to sort of leverage off my experience from my investment banking days, because as you all know, it's an industry that is dominated by bonuses, the bonus culture. And I want to talk to you about the sheet. You might be wondering what I'm talking about. And the sheet refers to a spreadsheet, an Excel spreadsheet. And on every trading floor, in every investment bank, up and down all the major cities, when it comes up towards bonus time, there'll be a senior manager on the trading floor that will be the custodian of the sheet. And on that sheet, he will have the name of all his traders. And next to that, he'd have he'd be putting in the numbers for the proposed bonus for that individual. I did that for many years, as both on someone who's starting in my early days on the trading floor, but also in my latter years as the manager and the custodian of that sheet. And it was a very interesting experience to see and learn the psychology of how performance pay, if we can call it that, is determined. And I think there were 3 key factors when looking at that and trying to come up with the numbers that may go in that sheet. The first one was I would consider the potential of that individual to generate future income. And I emphasize future income because often we think of performance pay as being for performance for the preceding year, for the year that's just gone by. But actually, economically, it makes sense to use it as a retention tool for future income that may be generated by that individual. Clearly, what they earned in the past is a decent indicator of that, but that's not always the case. Secondly, it reflected the competition for talent. In my case, I was running a trading floor in my last job in banking in Singapore. My bank was expanding rapidly in Asia. If, for example, I was looking for a fluent Mandarin and English speaker that understood derivatives and also was a good marketer, there actually weren't very many people that could do that job. And so therefore, the sort of potential bonuses, the total compensation package you'd pay for that individual would be reflect that scarcity of skill. And thirdly, and perhaps the most important point, and I think it was just alluded to, is the power of management. And I think that is something that has changed probably quite dramatically over the last few decades about how large companies are run. Because essentially today, because shareholders are so widely dispersed and there's so many of them, millions and millions of small shareholders, there's been an inevitable dispersal of ownership. And that has entrenched management power. And I think that has given management, whether we're talking about banks or other very large companies, particularly multinational companies, the ability to extract very vast, what we can call rents for what they do. And many of the executives will, in effect, sort of look after each other. They will set limits on pay, but they will be their own limits, not really from the outside. They will look at regulating themselves. And there's a sort of culture where any director who votes for the lowest plausible pay rise is not one that's probably going to survive very long in that institution. You could say it's sort of equivalent to the man that never stands his ground in the pub. And that's the kind of culture, I think, that has developed. And I only point that out just to see that how difficult it is to try and sort of overall deal with this issue. I think the biggest change that has already taken place is in the marketplace in terms of the performance of companies, not just with banks and others. The whole world economy is in a very different spot than where it was a few years ago, and lower profits, lower sales and performance, I think, already has had an impact. That's why we've seen this sort of recent so-called shareholder spring. I think that's a key issue. To finish off with, I don't think myself that there's anything wrong at all with variation in pay. There's nothing wrong with high pay per se. I think the key thing that most people would agree on is that people who do get high pay should be rewarded for success and not be rewarded for failure. The government's approach, as set out by Vince Cable over the last few months, I think has been quite clear. There'll be a lot more detail to come in the preceding weeks and months, but it is to focus on transparency in general, to make sure shareholders and the public at large and the employees of a firm have a lot more information, put it in a lot more intelligible way than they currently have, and also to have binding votes by shareholders on executive pay, which I think those two things combined is clearly the right approach. I don't pretend for a second it will deal with all concerns that people have about executive high pay, because at the end of the day, it is a value judgment, and even if someone is, in one person's eyes being rewarded for success, there will always be someone else that has a different value judgment. But I think the government is right to try and tackle this issue. Thank you.
Thank you very much. Well, our second speaker, as Peter Mandelson's words, a party that is totally relaxed about being people filthy rich.
Thank you for that.
Chris Leslie.
Yeah, okay, well, I won't necessarily start from that point. Sajid, it's a delight to follow you on the platform today. I know the Chancellor's a very busy man, some say part-time Chancellor, but thankfully we have Sajid holding the fort at the Treasury when George Osborne's out and about doing other things. And actually, I'm afraid to say I find myself in agreement with quite a lot of Sajid's comments today, because, well, I'm wary, let's put it like this way, of too much agreement breaking out across the political divide. Essentially, I come from a point of view where my constituents in central Nottingham feel very disconnected from some of the behaviour of those executives at the top of some of corporate Britain, particularly the banking sector, and there's a great deal of aggravation about that disconnect from within one society, as though we're living in a world where people are totally disconnected. And I think it's also a point of view where we need responsibility, yes, at the bottom of society when it comes to making sure that we encourage people to work and do, make their contributions, but we also need responsibility at the top of society as well. And there are different ways of addressing this executive pay issue. Some people, I think, would take a very sort of heavy-handed regulatory approach to, do we need some sort of minimums and maximums and those sort of interventions. But actually, I think the point Sajid was making is broadly correct in that the key failure is this mismatch between the balance of power between those who own corporate Britain and those who manage it. That classic principal-agent dynamic that has swung far too far off balance. And essentially, what we need to do is have a self-governing dynamic within corporate Britain to make sure that executive performance is rewarded if it is genuinely good, but if it is not deserved, then it does not perpetuate itself. And we've found ourselves in a culture that is radically in need of change, and from time to time it is the role of legislators, of governments, to try and prompt and cajole and change that culture to hopefully kickstart a healthier corporate culture which gets these things absolutely right. And so I'm interested in the set of policy interventions that can actually help bring this dynamic back into what might feel like a more natural order. How can we do more to perhaps encourage this shareholder awakening, the shareholder spring that some people have seen recently, so that senior executives take notice when it's, when there is shareholder disquiet, so that they talk to the owners of their businesses more frequently, and that we don't have the kind of Fred Goodwin type arrogance sitting, folding their arms in total dominance and only ever willing to act if it's 50% plus one of the shareholders who come together. And the fragmentation, as you were saying, Sajid, of the shareholding community is a real issue. Not least because I think there's a shadow cast from the states, the sort of antitrust regulations and so forth, where a lot of institutional investors and others feel sometimes as though it's inappropriate to talk to one another about their views of behaviour within certain senior management ranks. These sort of acting in concert rules that are pretty global, I think, personally need seriously reviewing, so that it is okay for institutional investors from time to time to share information and to talk about the behaviour collectively of those who manage those large organisations. And so I think it's that set of issues that we need to begin to look at, because after all, those institutional investors are stewards of our money and our investments. They, as pensioners, as ordinary investors, they have the voting rights which can be cast and to hopefully make sure that these companies are performing well for those who own them. And I think it's dangerous sometimes to only see this in a kind of public and formal context, as though the influence of shareholders can only be exerted at AGMs and in a public way, because of course there is a difficulty for institutional investors. If they shout too loudly, the publicity that then is associated with that might have an adverse effect on the share price. And so a lot of institutional investors, spotting a dysfunction within management, would far often rather sort of sell and exit rather than staying and trying to fix and improve the management culture. And somehow we need to make sure that whether it's offline as well as online, those institutional investors can have an appreciable impact. And that things are changing. The ABI and others have been making very positive noises recently about that. But my view is that there are a set of reforms that are needed to help speed that change along. And a lot of those are to do with transparency and information, so that shareholders at all shapes and sizes can get that basic information about what is going on within those senior executive ranks. So simplicity of presentation on pay awards. We have such a multiplicity of ways in which remuneration can be packaged up and sliced and diced. And in a sense, I think some sort of standardized or move towards some sort of standardization of reporting so that you get a sense of what are those basic pay arrangements, what are the performance, the performance aspects, and try and keep it simple. I think there are other ways in which we need to shine the spotlight of disinfectant into some of these murkier corners. For example, the appointment of remuneration committee consultants is still too driven by managers themselves. Of course, like a sunflower facing the sun, those remuneration consultants will make recommendations that they think in future will ensure that they continue to be reappointed. We need those remuneration consultants to be appointed by shareholders and not by the managers perpetuating that particular arrangement. We need more information about pay ratios, I would suggest, so that it's not just about executives, it's also about all of those who participate as stakeholders in a company, including the employees. And that's why we've suggested, for example, looking at employees on those remuneration committees. What sort of ratios do we have between the highest paid, the median pay within a company? So it's that set of changes. full disclosure of voting activities by those institutional investors as well, so that the rest of us can somehow have a better sense of how institutional investors are themselves behaving. It's that dynamic of improved accountability that we ought to give a better chance to work properly, because otherwise we end up with a market dysfunction and a sense that executive pay has run away out of control. Those are my thoughts for the time being. Thanks.
Chris, thank you very much indeed. Our third speaker, James Barty, financial policy advisor here, but from a strong city background as banker and hedge fund manager and many things besides beforehand.
Thank you very much. I thought for a while, actually, I was going to agree with pretty much everything Chris said until he got to the end bit. Now, Policy Exchange, we're trying to contribute to this debate. We've already put a submission into BIS on the subject of shareholder voting and pay caps. We're going to publish our full report on executive compensation next month. What I'm going to try and do today is just actually sort of outline some of the conclusions of that report. Our prior is it's not wrong to pay executives for good performance. I think everyone kind of agrees with that. And we still want to make sure that good executives want to come and work in the UK. And we therefore need to make sure that whatever we do in this, you've got a structure which attracts people as well as addresses some of the flaws in the system. And we must admit there have been rewards for failure, there has been substandard performance, and those rewards kind of need to come to an end. So, I mean, our proposals are basically aimed at meeting both objectives. Now, I thought I'd start by being slightly controversial and putting what I think is some poor analysis to bed. Now, Anthony said at the beginning, why should executives be paid more when your return on capital is the same as it was 20 years ago? Well, there's a whole bunch of reasons why you might want to do that. Return on capital obviously ignores the size of the capital employed itself. You know, if you've managed to quadruple, quintuple the size of capital employed and keep your return on capital the same, then I would actually argue as a CEO you've actually done a pretty good job. Now, a lot of the analysis that's done on corporate executive pay refers back to a company called Market. Now, this was quoted in the BIS report earlier this year, the one that often does the rounds, which is that the average FTSE 100 CEO's pay has gone from £1 million in 1998 to £4.2 million now. Now, that's normally followed by the question of how can this be justified? And for example, and you get some very bad pieces of analysis, the BIS report actually compared the change in the FTSE 100 to the change in CEO pay. Now, anyone who knows anything about financial markets knows that that is fundamentally flawed. For a start, the FTSE 100 doesn't include dividends. It doesn't include anything about the rating which the FTSE 100 is on. So the FTSE 100 in 1998 was on a PE ratio of 40. Today it's on a PE ratio of 10. So just to keep the share price constant, you'd have had to triple profits. And in fact, that's pretty much what CEOs have done. The FTSE 100 profitability over that period of 1998 to today is up about 300%. So if you look at pay going from 1 million to 4 million, but profits tripling, then yeah, there's still a gap, but it's not as big as people actually think. Secondly, if you look at the size of the average FTSE 100 company, the FTSE 100 companies are not the same today as they were then. You've had a whole bunch of what were previously foreign-based companies that have come into the FTSE 100. They're bigger. The average market cap, even though the FTSE 100 hasn't changed much, is up 40%. Turnover in those companies is up fivefold. So if we want to just turn around and go, actually, look, exec comp's gone from 1 million to 4 million, completely unjustified, well, actually, I can justify a big chunk of that move by the improvement in profitability, higher turnover, bigger companies. And you know, the more complex and the bigger a company is, arguably, the more a CEO should be paid. So I would argue that is the rise in compensation too high? Not necessarily. However, I think that's not to say that the current system is not in need of reform. And I think the shareholder spring actually just shows that far too many people have got away with particularly what I would say is substandard performance, not even necessarily rewards for failure. And I think there's some good reasons for that. If you look at any incentive plan, any long-term incentive plan, there are lots of targets which, if met, trigger either partial or total payouts. But they're all upside targets. It goes back to what Sajid was saying about the way bonuses are set. you set bonuses for meeting targets. I think there's a big flaw in city pay, and we're going to come back to this at Policy Exchange, which is if you fail, if you make losses, you should actually pay back some of the money you've been paid previously. And I've seen traders at investment banks walk away career-to-date negative as far as their P&Ls are concerned, but they've still kept their past bonuses. And you've seen CEOs walk away having destroyed value, still getting payouts. So take, for example, the Aviva CEO of late. Any, I think, objective judgment would say he failed, but he still walked away with a £1.75 million severance package. The BIS proposals, by the way, for exit caps wouldn't really affect that because Aviva would have had to fire him. Actually, they ended up with an agreed resignation. What we want to see at Policy Exchange is a system where, just as you have upside targets for pay, which trigger payouts, so you have downside conditions, which if breached, would trigger clawback. So it's about making long-term incentives more balanced. And if you take, again, for example, the Aviva CEO, share price massively underperformed, it would have triggered a clawback. So instead of the guy walking away with a severance package, he may have actually even ended up paying back money to the shareholders. So I think clawbacks are absolutely vital. We run through this in a bit more detail, I'm sorry, St. Anthony, in City AM this morning. There's an article in there that you can read. What else would we change? I thought the point about the economic cycle and executive incentives is quite important as well. Far too often, these long-term incentive plans are not really long-term. They're set to pay out over 3 years. Now, any good economist will know 3 years is only a small part of an economic cycle. So if you're paid out over 3 years, you could just be riding a wave, get paid out, company collapses. And I would say, if you want to look into an example of that, Cable & Weiss is a really good example of where exactly that happened. So one of our proposals is to take long-term incentive plans and make them pay out over 5 years. So you can actually demonstrate whether you as a CEO have actually added something over the economic cycle. We also want to empower shareholders. I thought the point that Chris made there is very important. Remuneration reports should be simpler, clearer, more transparent. We're actually going to set out what we think is a template for those in our report. We also want to put in place a kind of catch-all clause at the end where the board and the RemCo would actually have to disclose anything which is meaningful to shareholders. A good example of what this would capture would be the Sir Fred, or now Fred Goodwin, pension hike, where they added 20 years to his service, in effect doubling his, or more than doubling his pension and not disclosing it to shareholders. BIS have also asked about binding votes on pay. Frankly, I think if you can't get 50% of your shareholders to agree with your REM report, it should be binding immediately. But what a lot of investors have said to us is, look, we want to be able to fire a warning shot at companies, allow companies to go away and change their policy. If they don't do that, we will then want to basically come back and get them again. So what we're proposing at Policy Exchange is what we call the 2 strikes and out policy. Now, that's already done in Australia. So we're suggesting that the threshold for passing an advisory vote should rise to 65%. If you lose that 2 years in a row, it becomes binding. On caps in relation to earnings, we talked about sort of ratios of CEO pay to employee pay. I think there's a whole bunch of problems there. Who's going to set that cap, for example? If it's politicians, I start to get very concerned. Anyone who just saw the fiasco over Stephen Hester's bonus, where you had Ian Duncan-Smith coming out in the Sunday newspapers saying, actually, it would be good for the government if he turned down his bonus. I think that shows exactly why government should get involved in actually setting pay. Shareholders, at the end of the day, should set pay, not government. So I'm very much against artificial caps. And as far as employee representatives on boards are concerned, or employee votes, I think, again, that creates all sorts of problems. In the end, it's the owners of the business that should decide what's paid. I think there should be much more transparency. I completely agree with that. But it's the owners of the business that should actually decide that. So I think our proposals would allow for the worst of the excesses of the current system to be tackled without deterring CEOs from doing their job. And that's what I think the government should be trying to do as well. Thank you.
James? Just before we move on, James, could you just clarify a couple of statistics for me? I think you said that the profits in FTSE had gone up threefold over the period, and you said turnover had gone up fivefold over the period. Wouldn't that imply performance had declined? I mean, clearly,
not necessarily. I mean, basically, you know, if turnover's gone up and your margins have gone down, but you've actually increased your profitability, it depends on what you want to do. Because at the end of the day, some projects can have a marginally lower return on capital, that can have a marginally smaller profit margin, but they might still exceed your cost of capital, in which case you'd still want to go and do them.
Thank you. Thanks for clarifying that. Right, Chris Cummings from City UK.
Good morning, ladies and gentlemen, and congratulations to Policy Exchange for staging today's debate. I think it comes at a very opportune and welcome moment. A word or two about my organisation, just by way of context before I begin, if that's okay. The City UK is the overarching body for financial and professional services. We are an apolitical organisation, so it's good to be here today to listen to the debate and take back into my industry the key lessons that we extract from it. Mine is an industry that hasn't prided itself on its ability to listen historically, and part of our mantra is a desire to learn from past experience so that we can steer our industry better, certainly in issues such as this. Amongst our membership, we have the nation's leading banks, insurers, asset managers, through to legal firms, and indeed through to audit organisations. So the full breadth of the 2 million people who work in financial and professional services. So that was the advert. In terms of the debate today, there are some overarching principles that we start with from our going-in position. And to echo very much the comments of the previous speakers, firstly, I think payments for failure are unacceptable. The research that we've done around the nation suggests that the public find payments for failure entirely unacceptable, and more to the point, don't understand why payments for failure take place. I think there is a degree of red top language that occasionally is the hallmark of this debate, and sometimes we need to delve beyond the easy headlines and talk about what would the options have been. Certainly in a world driven by employment contracts, is there a better way of explaining the decisions that have been made? But if we set that aside and say payments for failure are unacceptable, surely this should be about engendering a culture of success across an organisation, not only in the boardroom. But certainly for executive pay, we should be looking for that most of all important point of relevance and ease of communication. And I would echo some of the points that we've heard earlier today about the fact that these decisions need to be more transparent, but more to the point, more easily understood by both the shareholders of the organisation, but for me in particular, the customers of the organisation, and delivered in a way through the medium of the media that means that we can carry public debate at this most precious time in the economic cycle, because this is a moment where our nation must prize growth, where we have to do all we can to be on the side of sustainable long-term value-adding business as we look for growth not only in our country and in Europe, but across the world. In terms of how this debate is impacted on financial services, and if we try to lead the debate, what would that mean for our industry? I think there is a moment for financial services to step into the spotlight and take a leadership position. We have to stay, of course, internationally competitive. One of the hallmarks of financial services is that we are the global preeminent financial centre. That's characterised not only by our historic reasons for competitive advantage, but also modern and current reasons for competitive advantage. Those internationally mobile people who want to build a global career view London as being the essential stamp in their passport even today. But that changes with things such as personal tax rate, the more obvious things, but also less obvious things such as culture, attitude and welcomeness. If as a nation we look to repel successful people, then where will our future success come from? And so I think we must always maintain an eye on competitive advantage whilst making sure that we do wish to carry the debate in the public forum. Of course, as a sector, we started on this somewhat earlier than other sectors by the regulatory reforms that are currently impacting on the industry and helping the industry reform itself. But it would be wrong of us only to look to our regulator to lead this debate. As an industry, we have to come to the table with new ideas as well. And so that's why I think for us the challenge is always going to be about wanting to hear from the public wanting to deal with the media and learn from the lessons that we've had to experience through the financial crisis and beyond, and look for moments such as this where we can identify how we can drive success not only at the top of the organisation but all the way through it too. I'm fascinated to be at today's debate and look forward to participating in it. Thank you.
Thank you, Chris. And finally, something completely different, a legal view from Jonathan.
Thank you. I'm conscious that I'll probably now confirm everybody's worst prejudices, that the lawyers just say there are problems. But I think it's worth just stepping back slightly, because it seems to me that we have all these arguments of principle, but what concerns me is the question of how. And actually, there's broad agreement, but what will take shape? And I think before we delve into sort of the regulatory ideas, one aspect just to bear in mind is, where does that leave trust? Because after all, the more you regulate, arguably the less trust there is and the more gamesmanship there is. So a point to bear in mind. I think it's worth just touching upon perhaps the principal ideas that are being advanced by BIS, and also perhaps picking up on one of James's suggestions, in particular the idea of clawback. Binding votes on future remuneration policies. Well, it's still going to include an enormous amount of discretion in any policy. Who is going to draft a policy which is entirely prescriptive? There is still going to be room for manoeuvre. And also, there's an argument that the vote should only be every year. But I would argue, does that give enough flexibility? What if there is a substantial change, either to the business or to the environment in which it operates? And we're talking a lot around the sort of 50% or 75% argument about approval. Looking at 75%, that's essentially getting you to almost a special resolution status, the idea of almost a constitutional change to the company. Is that where remuneration should sit? I also wanted to just touch a little bit upon the advisory vote on policy remuneration. So this is going to happen afterwards, and the shareholders are going to be given this amazing opportunity to say what they think of the year that's gone before. Well, actually, it's interesting that this is already suggested at 75% approval, but what is the ultimate sanction if it doesn't work? The company will have to make a statement as to what it's going to do to take into account shareholder views. That's it. So what an enormous gap in the architecture, because it seems to me that ultimately the only true sanction you have is either deselection of the remuneration committee or possibly just selling your shares. So for all the fanfare of change, is that really sufficient? We're also looking at binding votes on payments, on exit caps. And there's been an enormous amount of publicity, obviously, around payments which are seen as rewards for failure, the very theme of this talk. But essentially, I think that the real risk with that is it will simply invite executives to say, well, if there's going to be a cap of 1 year's base salary, please just increase the base. It is bound to act as a ratchet effect on that. And we all know that people discount variables in the future. The recent statistics have been shown by the London School of Economics report about the psychology of incentives show that to be true. And this must be particularly the case if you are spreading out your LTIPs to 5 years, if instead of 3. So more and more people will focus, it seems to me, on cash. And I think also it's seen as an idea that people might be happy to wait for shareholder approval of an exit package. If I was sacked just after the AGM, would I really be minded to wait a full year to see what my package might be? I would hazard a guess not. Would I instead be tempted to bring a claim on one of the statutory grounds to do a settlement and then have a package on that basis which wouldn't be covered by the proposed regulations? I know which I'd go for. Then at last, the final issue really, which is clawback. And it's offered as something of a panacea. I'm not sure it is so straightforward. Clawback covers many things. Clawback could include recovery of sums paid over. Can we have the yacht back, please? It could also be over deferred income. And the issue there, however, is how do you defer? What proportion should be deferred? And also one has to be particularly careful with directors because it has to be truly conditional. If you just put it in the escrow account, as has been suggested, well, that in itself might invite a tax treatment, as people have seen in the city, where you have to pay the tax on monies yet to be received. So I don't think that clawback is entirely straightforward. Now, I've cantered through some of the issues which I think are the devil in the detail, and so perhaps might suggest that the traditional cry of let's kill all the lawyers first is going to remain aspirational.
Thank you very much. Well, it falls me then to open questions to the floor. I would imagine there's a microphone or two. Who would like to kick things off? There's a lady in the front row here. Can you give your name and organisation for the benefit of the speakers?
Christine Berry, Fair Pensions. A lot of the focus of the government proposals and a lot of what's been discussed on the panel is about kind of managing that principal-agent relationship between managers and shareholders, and that's really welcome. I suppose my question is, a few of the panellists have pointed out that institutional shareholders themselves are agents for sort of millions of pension savers and so on whose money they manage. So do we need to look at that principal-agent relationship as well if we want to kind of get the whole picture in terms of how to tackle executive pay? Do we need to look at some of the things that the K review is looking at, like, for example, interpretations of investors' fiduciary duties and whether they're kind of discouraging long-term stewardship of businesses and also at kind of empowering and encouraging savers to hold their agents to account so that the market for stewardship and for engagement can work better?
Thank you. So the agency problem exists with the shareholders as much as with the managers, and should we be looking at that as well? Well, that's a policy exchange question, probably.
I have to say, I think that one's a tough one because whilst a lot of the proposals that we've suggested try and deal with the agency principle issue for executives, and I think clawback notwithstanding Jonathan's sort of reservations there is a way to do that because obviously you can basically put in place losses as well as profit. As far as shareholders are concerned, it's so diverse normally. If you think about a pension fund, do you want every single member of that pension fund to have a vote so they can advise the shareholders of that pension fund to have a... I mean, I think you get into really tricky territory there. Clearly, shareholders need to have a fiduciary duty to actually the owners of that pension fund, but going beyond that, I think, is a real hornet's nest.
I can, if I add to that, I mean, I agree with that. I think it's a very difficult, it's a real issue. It's very difficult to deal with. Actually, Ferdinand Mount has just written a book called The New Few, where he talks about this issue in detail, and anyone's interested in it a bit more, so it's a good read. And I think I'm right in saying that about 11% of shares in Britain on the British, on the main stock exchange are held by individuals, but they're typically held through nominee account structures, and because of that structure, they actually wouldn't receive a voting card at an AGM or something, so even as individuals aren't sort of having a say on issues or a say on pay or anything else. And I think maybe that's one area that can be looked at, where at least where they're held by individuals rather than institutions. But overall, I think this is just the way capitalism has developed. It's one of the, I think, ongoing issues, and I don't really see how it can be mitigated to a great extent.
Chris?
Yeah, well, I mean, Fair Pensions have done some pretty good work on this stuff, and I think this whole point about how can you open up that market for institutional investors. So yes, you're right. It's maybe in that idealistic world, as a pensioner, I can express a view on that basket of investments that institutional investor then acts upon. Of course, in reality, that's the sort of equivalent of direct democracy, totally impractical. But I think if we had a better disclosure about the behaviour of those institutional investors, then maybe those people who want to have a general view about the attitude taken, whether it's an ethical investment or sustainability, whatever the sort of view of that particular investor, then they can choose between those pension providers, those investors, institutional investors, accordingly. And so I do think we need more transparency. I mean, there's a bit of a sort of bitter irony on the Aviva experience recently, because actually, just as they were beginning to be far more activist and to exert their role as an institutional investor, they were then bitten by the problem themselves internally. But I do think it matters. That golden thread of accountability ultimately has to somehow come back to the people whose money it is in the first place.
But isn't the deeper point behind Christine's question the fact that the institutional shareholder actually doesn't act in the interest of the people whose money it is? The institutional shareholder is running a business and they put their business first. And their interests and what is important to them are fundamentally different from the interests of the long-term shareholders. So how does one address that, or does one address that?
Well, I mean, I would be loath to somehow have legislation clunkily trying to, intervene with firm ways of doing that. But I think what you have to do is change the culture and the set of disclosure requirements so that people have a sense of transparency about what is actually happening. What are those institutional investors doing on our behalves? Quite honestly, I mean, these days, this gets back to the dysfunction of the pensions market more generally. I mean, take the random individual in this audience who may well have 3, 4, 5 little parcels of pensions. Who knows what is being done with that money in your name? And that's part of the whole problem. We need a clearer set of reporting mechanisms so we know what those institutional investors are doing, because it's too easy for that opacity to then see institutional investors almost colluding with managers and senior executives rather than acting on behalf of the people for whom they are stewards.
Thank you. Now we have another question in the front row, and then the gentleman behind.
My name is Christopher Tugendhat, and now in the House of Lords. I have been chairman of 2 FTSE 100 companies in my time.
Including Lehman's.
I would make the following points. First is, I think it's important to distinguish between what's happening in the financial services sector and top executives of FTSE 100 companies. These are a different set of problems, and the remedies are different, and I'm focusing on the FTSE 100 companies. I think the most important single point is the need for transparency and simplicity. I mean, it is the complexity of incentive packages that has caused a lot of the problems. Like Dodd-Frank in the United States, we must have a single figure on which people can focus so that shareholders, the general public, know what the chap is being paid for, what the objectives are, and can measure success and failure. I think that's absolutely critical. I think the second point I would make is that one must be a little bit cautious about the international market in talent. There are some places where there is an international market in talent, and that is, of course, particularly true of the financial services sector. It's true of mining. I was a non-executive director of a mining company, and it's certainly true in mining. But the great majority of executives in the great majority of companies are not going to up sticks and go to California or go to Italy or go to Germany. And for one thing, they don't speak the language in half the places, so they couldn't, but children, wives, all the rest of it. We must be very skeptical about the argument of the international market. There is one, of course, and what does tend to happen is that when very large sums of money are paid for internationally mobile executives, often justifiably, that then drags up the pay of other people who are not themselves internationally mobile. And I think one way of dealing with that would be if you had a budget for senior executive pay, so that if, and after all, you have budgets for most things in most companies, and most executives are accustomed to the fact that if they spend more on one thing, they have to spend less on another. And therefore, if you had an overall budget for the top group, however defined, you pay more to somebody for whatever good reason it might be. That means the pool for the rest is less. And finally, I do think we have to find some way, and I don't know the answer, but I do think we have to find some way of involving the workforce in this. Business is part of society. This is a socio-political problem. I think it is important that those who run businesses should be obliged in some form to justify to those who work for them why it is they are being paid, what it is they're being paid for.
Thank you very much, Christopher. Gentleman there, and then Dominic Lawson. Gentleman by the door was first.
Thanks. James Drew at Maitland. I just wanted to really say that, I mean, whilst the idea of, the attraction of democratising the whole process and, through the shareholder spring, we can see that things are moving in the right direction. I think we need to stay pragmatic. And the idea that shareholders were going to be asked on a sort of almost on a regular basis for their views and on individual pay packages, etc., seems a little bit over the top. But perhaps one thing that might be very sensible is seeing how shareholders could be encouraged to be much more involved in the appointment of board directors. Sajid said himself that one of the problems is that there's a bit of a, board directors felt to be letting the side down amongst themselves if they make the decisions. And I think board directors need to be enfranchised much more by shareholders themselves. And in Sweden, I've mentioned this before, but in Sweden, the biggest shareholders constitute the nomination committees, and that seems like it could be a workable solution that would be much more pragmatic.
Thank you. Can we just have a pause? Chris needs to leave at 9:30, which we're pretty well up to. Is there any last word you want to make before you leave? Or?
I'm ejected from the panel. No, I'll be all right. Maybe I'll hear a couple more points, and then. But I'd like to come back on that question about director appointment, because I think there is a bit of, if we're honest, there is a closed shop. It's a very cloistered circle that tends to be, appointing to each other's remuneration committees between some of the senior boards. We do need to open up that process somehow, and I'm not, saying that somehow merit shouldn't come first. Of course, it should in that process. But again, I think that is you're entirely right that is an area we need to go down. And whilst of course there are reforms to AGMs, to voting rights, and so forth. Actually we need to be far more pragmatic and fluid in the way that shareholders are active on a daily, weekly basis. I mean, they should be in dialogue, in conversation. They shouldn't require, the votes at AGM should only be the last, nuclear options. In the sense, there should be information and a flow to help temper so that executives get a sense of what would be their shareholders' expectations on these kind of things. And that's why I was going back to those acting in concert rules, some of those, the ways in which institutional investors do, of course, keep their eye on the pulse, their finger on the pulse of what's going on in a company. But it's got to be more than that, quarterly reporting bottom line. It's got to be much more about where is the business plan going and so on and so forth.
But the problem with that, for the debate, the problem with that is, and it's to Christine's earlier point, that it's against the business interests of the shareholders to do it because they don't get paid for it. It just costs them money. Mm-hmm. So all this governance stuff is a cost for which they don't get rewarded because the structure is such. So it's not in their interest. Anyway, Dominic Lawson.
Yeah, I don't want to be inhospitable to policy exchange, but James, I think this argument about turnover is rubbish. I mean, turnover itself is a rubbish concept. And actually, profit is a rubbish concept if you're not talking about profits, earnings per share. If you're talking about the interests of shareholders, all that matters is earnings per share, because that's what your dividends come from. And I think a lot of these mergers were motivated by turnover, because there was the sense that if the company's turnover goes up to 5 billion, whether the chief executive gets £5 million or £10 million is completely irrelevant to shareholders. Of course it is. It's de minimis. So I think we need to get away from turnover. Earnings per share is what counts. That's what dividends comes from. That's what shareholders should care about. I have a question for the politicians. If you're talking about democratization and the electorate having a vote, presumably you would accept also, logically, that the electors should have a say in your salary.
Which they do.
And no, they don't. They don't determine it. You're talking about complete democratization. You're talking about the shareholders having a direct say. Okay, not the top salary review board. You're not talking about that. You're talking about the shareholders. That's the voters. So if you think that in principle, I'm not talking about the practicality, if you think in principle it's right for every shareholder to have a direct say in the salary of the directors, do you agree in principle it's right for your electors in Nottingham, or whatever, to have a direct say? They have a little bit of paper, it could say, you could pay this man 30,000, 40,000, if you tick here. Are you in favour of that? And if you're not in favour of that, why are you in favour of it for companies?
Well, I think sometimes argument by analogy is one of those sort of devices you could go around in circles on. I personally don't think that it's a comparator between elected representatives. Okay, we have a representative democracy, we don't have a direct democracy, and what's happening in terms of executive pay getting out of kilter. It's an interesting concept, but I think pretty much you can be certain that the story of the last 7 years, is it, since the whole parliamentary expenses scandal is one, directly or indirectly, of the public exerting their views and achieving a particular result when it comes to the behaviour of parliamentarians. I mean, that has affected and changed parliamentary behaviour pretty radically in a way that hasn't happened in the boardroom. Now, what I want to do is seek to achieve a pragmatic improvement in the way in which the accountability circle ought to work. And we can pick holes in the processology of that all the way through, but I think most rational people would say it's just not working currently.
I think that also, I mean, we have enough legislation as it is. I don't think we should give them performance pay for more. Perhaps we should reward or bonus our MPs on doing less would probably be the answer. There's a gentleman at the back there first, I think, by the hat stand.
Thank you, Chairman. Harry Braund, UK Shareholders. Anthony Hilton, you're 100% right when you say that an awful lot of the institutions are not doing their job because they have under their control an awful lot of small shareholders' funds. Now, if they're not doing their job, then the small shareholder is effectively disenfranchised. And the other reason why he's disenfranchised is because he is, in many cases, has his funds, his money, not OPM, not other people's money. He has his money in nominee accounts. Now, nominee accounts are cheap ways of dealing, but they're difficult to get the documents you need and the voting power to go to an AGM. I was at a investment trust AGM yesterday, and a long-established one, and it's 7% underwater in terms of performance this year. That's not really surprising with the market the way it is, but it was pretty damned poor performance. But 99% came up on the board with all the voting for everybody concerned. The issue for me was, however, Chairman, that only 40% of the shareholders voted anyway. And I suggest that an awful lot of institutions didn't even bother to vote. So the small shareholder is in many ways being disenfranchised, and it's necessary for the government to look at this idea of a central security depository, which I suppose is like a land registry, where everyone has their rights, as you have in a CREST account. But there's a lot of issues here where small shareholders are disenfranchised.
Let's bring somebody new in here. Jonathan, as a lawyer, do you have a view on enfranchisement or otherwise, or the questions?
There are immediate practical difficulties, as have been highlighted, in trying to enfranchise all. I think you're also neglecting the stewardship code that is there. And I think perhaps it does come down to a degree of visibility, as we know that there is engagement anyway between companies and shareholders before we get to the AGM. But perhaps that's the point, the lack of visibility on engagement.
So
my apologies. I've got to move on to the next meeting, but we'll see where this all goes. Thank you.
You're not going to vote, I trust.
No, not voting.
Thank you very much
Thank
indeed.
you. Cheers.
Chris, you want to ask a question?
Just a couple of comments on the question so far, actually. The first one, I think the expression around shedding daylight, transparency being the best disinfectant, actually, I get the sense that there is a groundswell of opinion for more transparency. That's exactly the right place for this debate to be about. And so I'm much more in favour of openness and transparency than traditionally has been the case. So that's a very positive moves that I absolutely welcome. The comment from the first speaker, Christopher, who kindly differentiated between financial and professional services and the rest of the market. Certainly on the international point, where as a sector, geographic mobility is one of the hallmarks of the sector. The issue that worries me second order is people leaving. The issue that worries me first order is people not arriving. Just those new entrepreneurs, those new very senior business people not coming to the UK. And so what we're looking at is a lost cost. And that's really the biggest challenge for me. And I think the third point, if I may, in terms of directors' appointments, and here I'm struck by a contradiction in policy, where we want to see greater openness in terms of who sits on the board. But actually what we're currently wrestling with in our part of the forest is a regulatory move to actually reinforce stereotypes in financial services regulation about the type of people who the FSA is happy to see on particularly bank boards. And I think there is a countervailing pressure there that we need to do a great deal more thinking about if we want our sector to move forward and actually show some of the leadership that's being evident in other parts of the sector. Financial services has got a very good news story to tell about women in the industry, and actually what worries me greatly is how the regulatory pressures are stemming the flow of people from various backgrounds getting onto boards.
Thank you. Can I just make a point against transparency? That it was when everybody learned what other people were earning that we got the ratchet effect. That because everybody wants to be in the top quartile, and they know what others are getting, that it's no longer a rate for the job, it's I must get more than fed down the road. And isn't that why the whole thing is ratcheting up all the time? So, in fact, we want less transparency, not more. Anyway, so the gentleman here, and then gentleman a couple of rows back. So, microphone to the front, please.
Chairman, thank you. I'm Adam Ridley, former Director General of the London Investment Banking Association, which is from that background I'd like to offer a comment or two. One of the interesting things about the discussion of executive pay, not least the discussion today, is that almost no one has made any hint of a reference to the competitive or uncompetitive conditions of the industries in which we are discussing the pay levels. Now, if you think of it in analytical terms, the issue today is executive pay versus profits. In other words, the partition of value added between the two economic agents. Going back to what Sajid very importantly said at the beginning, much of what is going on is a struggle for a share of value added, but there's something else going on, which is how big is value added. Now, over the long period since the middle 70s, something quite astonishing has been going on in the pay received by the top 1% in any Anglo-Saxon country. The most extreme case I'm just going to cite comes from a very fascinating recent study by Atkinson and others, and I'm going to just give you 3 or 4 figures to ponder. In the United States, the average real income growth for the top 1% of the income distribution over the 35 years from 1976, the average was 1.2. The bottom 99% earned half of that, 0.6% per annum. The top lot earned 4.4%. And how much do you think of the extra income did that top 1% take? They took nearly 60% of the growth of GDP over a 35-year period. Now, if you just stop and think about those figures, you will then bring it back to today, bring in one other point. If you look at the dynamics of top pay determination, starting off with the investment banking world, it's a relatively small number of people who are working, as Sajid describes, in this very fascinating trading room context. They then create comparators that spread within the firm. The remuneration consultants then generate a comparable set of benchmarks that then spread out into the senior professionals. From there it goes out into the FTSE 100 and so on, ever wider. Amplified, as Anthony very properly says, by the ever-growing amount of information. Now, under these circumstances, I'm all personally for the reforms that we've been, I think, very largely witnessing agreement on. But the idea that you're going to be able to push back this incredible tide of growth that's probably driven by growing oligopoly across a wide range of industries, but particularly in investment banking, the idea that you're going to make much difference is completely cuckoo. And when you sit inside a business trying to make these decisions, if people come to you and say, I'm going and I'm taking the whole of my trading team with me, I'm going off to set up a hedge fund to compete with you, and we're going to take all my big top FTSE accounts, you cannot but pay them what they demand. So they're going to go on gouging, and if you can go on gouging yourself, then you will happily go on doing so. Thank you.
Thank you very much, Adam. Very sobering analysis there. Thank you. Now, this gentleman here, yes, in the second row.
Jim Clement-Jones, DLA Piper and House of Lords. Taking the debate slightly more widely, I wonder whether the remuneration issue doesn't demonstrate a fundamental flaw in the unitary board system, and whether or not we should be moving towards supervisory boards. I don't know if there's any evidence that on the continent pay has been less of an issue, but it'd be interesting to know whether the panels have views on that.
Can I respond to both of those?
Please, yeah.
Yeah. Well, first, I'll just take that last point first. I worked for 12 years for Deutsche Bank, and as you may know, it has a supervisory board, and I don't think it's any less of a problem because it has a supervisory board. The point that Adam about investment banking and the pay. I mean, I think you made a very fair, very insightful, very incisive comments there. And I agree with a large part of what you said. I think it is very, very difficult to change that culture because of the competition and things. And also, we should all bear in mind, and it doesn't just apply to investment banking, but we're all shareholders. Everyone in this room, I'm sure, has got a pension fund. Unless you work for the public sector, your pension fund is invested in stocks and shares. The reason we have these investments is because we want the value of that pension fund to go up. And if the stock market is in a bull market, it's doing very well. We are just not that inclined to get involved in decisions of who the directors are, what the pay is, and so forth, because we feel that we're doing well. It's only when things take a downturn, as we've seen in the last few years globally, that individuals will get more concerned about those pay packages and who the directors are and whether they're getting value for money. And it will be interesting to see, after we've had this shareholder spring and so forth, when the world does enter a bull market phase at some point in the future, whether Policy Exchange will be holding debates like this. Because I would postulate that I don't think it will be as big an issue anymore, as long as we feel that the earnings per share, the share price, is going up, and we feel that we're doing better. There are changes already, I think, sensible changes made in the investment banking world that I hope will stick, even when we move back to a bull market in the future. And part of that is this whole idea of clawback, for example. That didn't exist in banking really before. Clawback came about after the financial crisis in 2008. And I can't think of a single major investment bank now that when it gives its so-called pay package, that first of all, a much larger portion of that will be in shares that will vest over time, and you will only get those shares at a future date. You don't actually own them on day one. And that allows the ability to claw back these shares if either the bank as a whole or your particular team doesn't do well or doesn't meet its targets. And that's already happened. I know of at least 2 major banks where clawbacks have taken place. The one that's in the news right now is at JP Morgan, where the clawbacks have already been activated with that big loss that was announced a couple of weeks ago. And I think that's a good thing. It's a good development. And I hope that things like that will stay even when we move back to a bull market.
Any observation about supervisory boards from the panel to the question? Oh.
I can't see how they'd be any better equipped to deal with some of the challenges.
Yeah, sure.
I mean, just first of all, I think Dominic's actually left, but I mean, I was going to come back on the point about turnover. And what I was trying to say there is that companies, if you look at the average size of a FTSE 100 company, it's got much bigger over the last 14 years. That's partly due to changing composition. And I was just using market cap and turnover just to actually illustrate that rather than arguing that a company should be paid or executives should be paid more for high turnover. On corporate governance, the interesting point, Chris kind of made it, which is that it's not always in the shareholders' interest to actually undertake corporate governance. And I did actually have one CIO said, look, this is a side part of what we actually do. It's not our main job. However, because of what's going on, because of the shareholders' spring, what I think you are beginning to see is that corporate governance departments within major institutions are growing in size. They're being better equipped. And I think they're taking their jobs more seriously. So I think there's already been a step shift in that. On supervisory boards, I also worked for Deutsche Bank, and I don't think they really add very much. The one thing we're going to do at Policy Exchange once we finish looking at executive pay is to look at corporate governance. And I think if there is a flaw in the UK system, it is that far too many non-executive directors are, if you like, talented amateurs, in that they take a lot of non-executive directorships at relatively modest pay. As a result, they don't spend very much time looking at the business. They don't understand the business. One of my suggestions would be to make non-executive directors as a whole more professional, better paid, with fewer jobs, so that not only can they understand the business, they can actually also hold the executive directors to account.
Can I just make an observation about supervisory boards as well, which is that I think we're getting them. I think if you actually look at what's happening in public company boards, there are fewer and fewer executives, more and more non-executives, and the non-executives are more and more concerned with governance and process and not with actually running the business. As a result, the decisions, the operating decisions, are being taken outside the board rather than inside the board. So we're getting a supervisory board by default, but not having a unitary board at all. Another question. Gentleman in the front, I think. Nobody else, is it? No? Gentleman in the front.
Yeah, Phil Aldrich at the Daily Telegraph. James, just a quick one. You talked about long-term pay schemes around 5 years. I mean, do you think that the annual bonus should be scrapped then, and we should just move to these longer-term schemes? And Sajid, you mentioned also that if you didn't pay in the investment base, you don't pay the maximum. It was like skipping around in the pub. And I just wonder if there's anything that can be done to encourage people to just pay a lower level. I mean, as it really refers to what Adam was saying, I suppose it's just the culture of really maxing it out. If you had any ideas on what could be done.
What we were going to suggest was that, I think the problem is that the annual bonus is generally determined on 1 year's performance, and then you've got these long-term incentive plans which are based on 3 years' performance. So what we were saying is that if you've got a short-term performance element, which is the bonus, the other bit should be actually spread out over a much longer time. So I wouldn't necessarily scrap the bonus, because I think if you make LTIPs 5 years and you scrap the bonus, all that's actually going to happen is the salary element is going to go up. So I don't think there's any problem at actually having a 1 year bonus which is focused on short-term incentives. What I wanted to do is make the long-term incentive to be much more based over a period where you can truly show whether the executives actually had an influence on the profitability of the company. And just actually going back to one point I was about on a unitary pay number, I actually think it's very, very difficult to have one pay number which includes salary, bonus, and LTIP, because the LTIP generally is a function of a number of previous years' performance, and kind of when it pays out is often a kind of random occurrence. So what we've suggested in our report is you have one figure for salary and bonus, which is very, very clear, and there's an element which is variable within that, and another figure which is LTIP. And I think, if you extend the LTIP out over 5 years, you are getting away from some of the short-term incentives. So I probably would leave the bonus element in.
Actually, could I go to Chris?
Excuse me, I'm suffering from a child-inflicted sore throat this morning. Anybody with young children will understand that they bring everything home from school with them, pictures and diseases. So forgive me if I'm a bit croaky. The point, a couple of points I wanted to make. The first one was around this confusion between who sits on remuneration committees and who sits on boards. That there was a very good piece of work done a few months ago which showed that actually there isn't this old boys club that seems to sometimes be the impression that's created. Never in policy exchange debates, I know, but the view that everybody sits on each other's board simply is not the case. So I would quite happily direct people to that research after the event, because I can't remember the URL at the moment. But the second and substantive point I wanted to make was I can't overestimate the importance of the clawback and the change in behaviour that's resulted and change in culture. And the fact that, please remember that this applies to UK organisations wherever they are around the world. So in Singapore, a UK organisation would have clawback, whereas an American investment bank wouldn't. And so the FSA remuneration code is a global standard, not just here in the UK. And so we are actually leading the way in this. To some extent at the detriment of our own competitiveness and attractiveness as a place to attract the best talent from around the world. So there are game-changing moves that have already happened. They need to be factored into the equation.
Actually, if I come in on that, well, I mean, first of all, some things are already happening, such as the clawback, and actually it's happening internationally. So even Credit Suisse, UBS, JP Morgan are doing it in New York or Switzerland and places. So it's an international development, which is a good thing. Something else that I think I get harder to do something about immediately, but when I was just trying to decide someone's bonus in an investment bank, one of the biggest things that they'd come up with when they'd walk in the office is say, I've made $10 million. Right? And obviously they would have their own measure of that profit that they think they've made. And I think that is an area, again, where there can be the measure of what is the measure of profit can be looked at. And give you a couple of examples. First of all, in the investment bank industry, in terms of way accounting structure works, someone might do a 30 years transaction, a swap on the present value or the sort of future income and call it today's profit. I think that is that's habit in banks is one of the things that led to more risk being taken on than otherwise, and I know this is being looked at by accounting standards boards around the world, an issue about how profits are actually measured, and I think that's it's worthwhile looking at that, and that will if that can become more conservative, that will have an impact on the measure of profit. And the other thing is that as we've seen with the Vickers proposals, that there is for large universal banks. There is an implicit state subsidy, and to the extent that I think the profits that investment bankers generate don't rely on a state subsidy, I think then they'd have a fairer sort of claim to actually making profit. But to the extent today that they are relying on state subsidies, whether it's universal banks, I think again their claim to the amount of profit that they're making because of their effort is somewhat tainted because of that subsidy. And again, in the UK, as far as British banks are concerned, because of the Vickers reform and the separation of investment banking from day-to-day retail banking, I think again that will be another positive development in respect to this.
Thank you, Adam. Yes, come with the microphone at the front again.
Chairman, thank you. I wanted just to come back a bit on the question of the disciplines that will be perceived by senior executives when they do press for high pay, and to reflect a little bit on what happened 20 years ago in the middle 90s. I was at that time sitting at Hambros and used to look at competitor costs, usually total remuneration per head, all the way across the 15 to 20 odd investment banks, merchant banks, call them what you like, which we had, or units in London. And there was one that stuck out like a sore thumb. I think I can say it without being offensive today. That was S.G. Warburg. They had a figure for well over £100,000 per head, down to the nearest man, dog, or library assistant, and most of the rest of us were jogging along on 50 or 60,000 a year. That meant Schroeder's or Samuel Montague's or Hambros. And I then started looking at all the corporate brochures and saw that the SGW corporate brochure picked out a fantastic number of offices all around the world. I thought, good God, something's going wrong here. And this made me think, for the first time, that this great name was going to come up against a brick wall of excess costs. And then when there was the next market turned down, sure enough, they fell flat on their face, they fell apart and were taken over by Swiss, or went off into Mercury and Merrill Lynch. Now, in those days, if you failed, you failed. But look what happened in New York a little while ago. Read Mr. Sorkin on what happened when the substances hit the fan in 2008 and 2009. Many of the people in Lehman Brothers, even in Lehman Brothers, did not lose their jobs. They went off to other populous bits of the world. And increasingly, most of us, if we fail in the investment banking world, will be in businesses that are too big to fail. Now, I think under these circumstances, we've lost a very valuable market discipline. There used to be potentially much more fear, much more likelihood of failure than there is today.
Observations? No? A man from Lehman's is rushing for the door. Thank you. Right, another question. Gentleman at the back.
Martin Smith. I work in Parliament for an MP on the Treasury Select Committee, David Ruffley. First of all, just a point about clawback. If we're saying that introducing clawback is reducing our ability to attract the best talent, are we assuming that the best talent means people who are scared of clawback? That's one question. But secondly, a wider point is about risk. If we are incentivizing people through some form of performance-related pay, you always run the risk that people will increase the appearance of their performance simply by taking on extra risk, as in making more profit simply by moving up the risk-return curve. Now, I appreciate that clawback and bonuses that vest over time, etc., will account for some of that difficulty, but still, it will still be possible to make the earnings per share figure that you report to the stock market look better simply by moving up the risk-return curve. So do you think there needs to be some kind of change in financial reporting to report not just the profit that you've made, not just the earnings per share, not just the return that you've made, but the risk that you've taken on in order to actually make that return? And a connected issue with that is how actually do we measure risk? Because if you were analysing the Royal Bank of Scotland around 06, 07, you would have said they've actually produced these profits, this fourfold expansion of their balance sheet without actually taking on too much risk, because all that they've issued is AAA rated instruments, and if you're an institutional shareholder holding onto those shares, you would report, we've invested your money in Royal Bank of Scotland, which is a low-risk institution, because it's invested in those AAA rated instruments and because it has a low equity beta, when actually it was all about to fall apart. So how actually should we first of all report risk as well as reporting the earnings that come with it, and do we actually need a new way to think about risk? Just to reduce the incentive to produce extra profits by moving up the risk-return curve?
My immediate reaction is it would be completely impractical, but I go to the experts. Do you think?
Well, I mean, first and foremost, the point about clawback is to make the payoff more symmetrical, so that actually, if you want to take the risk of going further up the risk curve, that's fine, but there's downsides to it. And in our document, obviously, which I couldn't talk through entirely this morning, one of the things we talk about as triggers for clawback would be a breach, for example, of a gearing ratio. I mean, that could easily be something you could put in. You could put a credit spread in. I mean, to some extent, that's going to have to be the responsibility of the Remuneration Committee. So the whole point about clawback is to rebalance, if you like, that zero-cost option, which they have at the moment, which is all of my risk is to the upside. I've got no risk to the downside. So I think you deal with that. On risk generally, could there be better reporting in annual reports? Yes, there could be. And I certainly think for banks, for example, the HBOS Civ never appeared in their annual report. So there's areas where you can go down and actually revealing more. I personally think a lot of the problems with banks, having worked for one, is that a lot of the risk committees that were actually inside banks, don't take this the wrong way, were actually run by traders rather than necessarily people that looked out beyond the horizon. So I would say this, but no, but there were not enough economists and strategists that actually were trying to look into the distance and say, well, actually, it's a great short-term trade, but actually you're taking a 30-year risk, and that risk actually looks very vulnerable. And the interesting thing I would say is if you actually look at the banks that largely avoided this, many of them actually had people who were taking that kind of long-term view sitting on their risk committees. And I think the common feature amongst all of the banks that failed is they all took very bad decisions and very short-term decisions.
Thank you. Adam has prompted me from the front row with the word Basel, which of course is that the latest Basel proposals do in fact put much more emphasis on risk and risk weighting and reporting of risk. However, I think we're probably actually at the bewitching hour where I have to draw things to a close. I'd like, I think in summing up, I've been struck by the general level of agreement in the direction of travel among everybody. Secondly, by the surprising complacency about shareholders actually doing the job. They never have in the past, and I think that the shareholders' spring will very quickly evaporate. Indeed, I was talking to one of its architects only on Tuesday who said that with each successive vote down, their power will diminish. And they are very much hoping that companies will pick up the baton before this becomes obvious. But they find that companies themselves don't know what to do because of all the reasons that we've talked about, of competitiveness and so on. So I think we need to be careful about putting all our trust in shareholders as delivering what we want. And I think that the other interesting thing that has come out, but I think that we haven't probably kicked around as much as we should, is the whole social divisiveness of the current pattern of pay, and the fact that ultimately capitalism depends on society, and society tolerates capitalism because it delivers benefits to all, not just to a few. And I think that if, as it were, business does not reform itself, then it will end up in time being reformed by others in a much more uncomfortable and painful way. So don't stand under lampposts, you may be hanging from them. Enough for me. Thank you all for your questions and your attendance, and may I ask you finally to thank our speakers for their time and their wisdom.